Earning money is not as easy as spending it. We earn while we work. We earn double our monthly income only if we do double shifts. But that doesn't have to be the case all the time, right? We can always have an extra layer of protection and source of income because in today's video, we will help you understand how investments work and how we can start small and end big with our own stocks. Yep, you heard us right. Hey guys, welcome to another episode of Financial Ventures, where we will shed some light on investments for beginners. Do not worry, we got you. We will try our best to help you understand your potential and how you can improve along the way with your financial status. If you like the content, be sure to like the video, subscribe to our channel, and hit the notification bell for more informative videos about finances. Remember, all you need is financial ventures in your life's adventure. We keep on hearing terms like stocks, investments, index funds, etc. Yet we don't necessarily catch what they are all about and how they function in general. Did you know that in the late 1600s in Amsterdam, the Dutch East India Company deployed more than 100 ships to trade gold, porcelain, spices, and silk all around the world? Yes, it was a costly business, yet they were developed to be grander every year when they decided to ask help from private citizens for shared expenses. In return, investors or private citizens who contributed were able to receive shares with the voyage's profits. Unknowingly, the Dutch East India Company started the very first stock market. This was the start of the greatest capitalist innovation that will shape today's modern economy and allow folks like us to grow our wealth. In today's time, stocks are more complicated and can be quite tricky to learn. Let's start with an example. You discovered a locally owned flower shop that sells the best bouquet arrangements. This flower shop has aspirations to grow its business to 6 to 7 figures in the upcoming years. This will only be made possible if people are willing to buy shares of the company to infuse the business with money, thus contributing to its growth, development, and innovations. Once their business starts to bloom and offers more innovative flower bouquet styles, other people will see the fruit of its labor, thus they would want to buy more shares. Over time, the company's value rises as several people buy shares, making it more desirable in the stock market. In that same manner, it can also incur losses when the flower season ends, and so shareholders experience losses along the way too. But in return for that risk, shareholders can be part of the growth of the company. But here's the catch. Stock market trends change because of human emotions. Yes, when investors feel that there will be complications and losses in the upcoming months, they tend to sell their shares to other investors, then making the value of the company plummet. It will only go back up once people are more confident to buy the same shares again. You see, emotions are powerful. They literally can close down a business. Well, that's an extreme case, but you get our point. Before fully diving into terms and differences of the stock market, we'd like to leave you guys and gals a simple reminder. Create an emergency fund and pay off debt. That's it. Before you can start your investment, make sure you have an emergency fund in your account. This can be the 3 to 6 monthly expenses saved in your bank account, and you should not touch it unless you need it. And of course, pay off debts before starting another commitment. May it be smaller or nonsensical loans, pay it off so that it will give you peace of mind while starting your investments, and this time with more room for financial freedom. One can never fully understand how the stock market works without understanding index funds and mutual funds. But before that, let's differentiate some of the terms we will be encountering along the way. Let us start with our good old friend, stocks. Stocks are ownership of a business. When you buy stock in a company or even a startup business, you become a partial owner. Over time, if the company does well and becomes more desirable, your share of the company will also gain in value. Of course, the opposite is also true. Benchmarks. Benchmark means the measure of the stock's performance or the standard that the stock market set in a certain trend or period of time. This is what we usually buy, or this is what makes a certain share or stock more desirable to the people. We usually call it the increase and the dips of the market. Returns, on the other hand, are the change in the price of an asset, investment, or even project over time. Positive returns giddy us all up. Or safe to say, positive returns mean an increase in the original stock you bought. Meaning, Your ownership of the stock has increased in value while still owning the same amount of stock, getting higher investment returns without even increasing your stock purchase. Okay, are we still cool? Because the index here would want you to know that they are the indicator or the measure of the stocks. As a general rule of the thumb suggests, it is just the typical statistical measure of a stock. Now, onto the biggest points. What are an index fund and a mutual fund? They actually differ to three main categories. The first one is through management style. When you say index funds, they are what we call passive investments, or we do not need someone to oversee or determine which investments or shares to buy and sell, since they are automated to track an index. Safe to say, if the stock is in the index, it'll be in your fund too. And that is the complete opposite of a mutual fund. A mutual fund's management style is active, which means someone has to make an hourly investment decision that can choose the fund holdings to keep their money growing and higher than the benchmark. In simpler terms, index funds will secure your investment through benchmarks they follow that are within the acceptable index, while the mutual fund will have to be handled by a really smart person so they can get your money's worth. Please tell me I'm not the only one being nervous about mutual funds. Just kidding. The second difference is through their investment objective. The investment objective of an index fund is straightforward. Just match the returns of the benchmark stock market index, while mutual funds will try to beat the investment returns of a related benchmark index. To make it simpler, index funds would just want to have matching returns, while mutual funds, being the competitive ones, aim to outperform the benchmark of their related stock index. And lastly, the cost. Mutual funds are handled by smart and competent people who understand how the stock market works. This is why their management cost is higher than the index funds. They pay their professionals their salaries, bonuses, benefits, and a whole lot more. Index funds, on the other hand, have minimal cost because Wall Street professionals are out of the equation. The real deal here is, the lower the cost, the higher the investment returns. A lot of investors are in favor of index funds, but who knows, you can be adventurous and bold enough to choose mutual funds too. Okay, just to set the record straight, today's video is quite a roller coaster, so we would like to end the video by suggesting some fund firms you can invest in. Also, it seems like index fund here is our favorite child, but trust us, they all work well. You just need to be well informed. We have Vanguard. They're not user-friendly, but they are a really good place to invest because they have very low expense ratios. So that means you can have higher investment returns. And don't forget, the S&P 500. It basically checks the top 500 companies, and so it makes you distribute your little investments across the top 500. But a total stock market fund is gonna let you distribute it all the way to the little startup companies too. How thoughtful, eh? Hey guys, we know we have been helping you understand the basics of finances, but always remember, you have the power to research things on your own and the ability to choose what to invest in. Be smart, be informed, and don't be afraid. We thank you so much for listening. Comment down your thoughts below and suggest what else you want us to talk about. We hope to see you at the next one, and remember, it's better with financial ventures in your life's adventure. Go get that money rolling and doubling even when you sleep.